behalf of Crosscheck Media and BizTalk Today TV, welcome everyone to the Money Path. I am your host, Todd Schoenberger. Joining me today is a very special guest. We have Maria Jelescu Dreyfus. She is the CEO of Ardinall Investment Management out of New York City and also a sitting board member for ExxonMobil. Maria, Happy New Year and welcome to the program. I have to start talking about oil. Obviously, it's a headline story with what has taken place in Venezuela and obviously the geopolitical tensions in Iran. But how do you assess with those tensions and plus potential supply disruptions, mainly in the Strait of Hormuz, how would you assess and calculate an actual risk premium to a barrel of crude?
Hi, Todd. Happy New Year. It's great to be back with you. Where do I start? It's so much happening since we
I
last spoke.
know.
Actually, we spoke, I think, before the holidays, and
We did.
we were hypothesizing about geopolitics and the implications of that in the oil markets. And I think we briefly touched on Venezuela and Iran as potential sources of uncertainty. And boy, were we right. A
You
lot
caught
has
it.
a lot has happened, and the the situation is so fluid, and you can paint a bear case, you can paint a bull case. When you put it all together, I almost don't feel like there is a geopolitical premium in oil. There's more volatility, there's more uncertainty, but I don't think that necessarily you have a premium today at $60 because when you think about it, you can paint a very bearish long-term crude supply demand dynamic. When you think about for example, Venezuela, right? 3 million barrels peak production. Yes, 20 years ago, but that could be the potential. So if everything works beautifully in terms of getting the country back in order and being able to tap into that resource, you can paint potentially a bearish long-term view on oil because of the extra supply that would be coming from Venezuela. A lot of things would obviously have to happen between now and then to get there, but I think that you could paint equally an up scenario and a down scenario. And when you net it all together, I almost don't think that you have a geopolitical premium in oil the way that you historically used to have it. It's more a volatility premium,
Okay.
if
So
that makes sense. Yeah,
it
yeah.
does make sense. And you're speaking of the EIA report that came out talking about oversupply in 2026.
Mhm.
However, OPEC is actually predicting higher demand around the globe for oil, which should elevate prices. So who's right, the EIA or OPEC?
Yeah, I mean, it depends on who you're asking. Of course, you'll get a slightly different view. And the truth is, no one really knows. So when it comes to supply, I think it's very well known that the market is heavily oversupplied right now, right? When you look at demand, when you look at supply, we all know that there's a surplus that will need to be worked through. On the question of demand, demand's been awfully hard to predict, Todd, and there's so many people counting and measuring and analyzing, and we still don't get it right. We're probably looking at, base case scenario, a growth of 1.5 million barrels, 26 versus 25. So you'll go from maybe 105 and change to close to 106 and a half, 107. But the reality is no one knows. There's so many different moving pieces. China was a big buyer to beef up their strategic petroleum reserve last year. We don't know when and if they will stop buying. So we can sit here and paint all sorts of scenarios. um, Over the long term, I think some of the excess oversupply will be worked through, but it's really hard to give you a definite timeline. The reality is the market today is oversupplied. But I think as we spoke about it last time, everybody knows it's not a surprise, right? So from a financial market standpoint, you could make the argument that oil sitting here, it's been kind of bumping around between 55 and 60. It's kind of priced in. Everybody knows that the markets are tough. Everybody knows that we're technically oversupplied. You're hearing, just yesterday there was a news about Harold Ham saying that he's going to lay down rigs in the Bakken and not drill anymore. So
Right.
you're it's not new news, right? And that's what
Right.
moves markets, new news.
Well, the oil currently, we're in a post-Maduro world, but we're
Hmm.
in a pre-regime change, possibly in
Hmm.
Iran. So
Hmm.
if Iran decides to shut down the Strait of Hormuz, though, I mean, you have to expect the
Yeah.
bid will be much higher for oil, correct?
Well, there's a couple of things here. The question is, will they decide to close down the Strait of Hormuz? It's actually in their best interest also to keep it going because that is the lifeline to the Iranian economy. The
Mm.
fact that they still have crude going out and they're selling it to various countries around the world. Um, you can also look at precedents, and we've had a lot of instability in that part of the world. And the longest the Strait of Hormuz has been, let's say, shut down or under duress, has been a few days. So, yes, you might see something happening there, but it's actually in everybody's best interest, including Iran's, to keep crude flowing through that critically important region in the world. And also, every disruption has historically been very, very short-lived.
Okay. Let's go back to Venezuela. You're on
Mhm.
the board for ExxonMobil. Darren Woods, who's the leader of Exxon, had spoken to President Trump and said directly, publicly, that Venezuela is uninvestable. I understand his comments with that, but what assurances does he need, or would ExxonMobil would need to actually commit to some type of a hefty investment in that country?
Well, I would say, and I'm speaking here more generically, you know, I would say that most companies probably feel the same way. The situation in Venezuela today is extremely unstable. A lot of the geology there needs very heavy capital investments, right? Most of the resource is heavy oil. And for that, you need to first invest a lot to be able to exploit the resource. The I I would say that any company, especially the public companies, the large publicly listed companies, they're watched and, with public shareholders. I think that they would need to see a significant change in the level of certainty, security guarantees, any sort of stability agreement with government, which government? That's another question. So my personal view is that you will need to see a lot of changes there before any large energy company would want to make a real commitment to that country. Uh, of course, there's always people with various risk appetites. There's wildcatters. It's well in the DNA of the energy sector, but those are
Right.
small. And I think you want to look at the large companies that in the context of that, I think they all will need to see a lot more change in the positive direction before they would commit to spending real money in the country.
And I can appreciate that. And so, and as Mr. Woods explained, ExxonMobil has been working inside Venezuela going back to 1940. They have a long history there. So, with that though, I would say, I would ask this question. Does it matter for ExxonMobil? I mean, are they going to get tremendous value out of being in Venezuela as or being out of Venezuela? Because there's been such a push for renewables in that company. Is there really a benefit for them to even be there?
So let me answer the question the following way. When you look at the math and the resource base in Venezuela, it actually is higher than the resource base
Hmm.
in Saudi Arabia. So for any oil company, you want to look at the potential opportunity. The potential opportunity is tremendous. That being said, there's a few things, right? Like, first off, is the political situation, the stability, the geopolitics in the region. Secondly, is the cost structure of that oil. As I was telling you, there's very heavy oil in the east, in a region called the Orinoco Belt. And there's a lot of oil in place, but it's also very hard to extract. It's very, very heavy. In the west side of the country, you have more conventional type reservoirs, and those are also geologically not easy.
Hmm.
And you have significant infrastructure damage that's happened over the last 2 decades. I read about significant power shortages. So the potential on paper is there from a resource standpoint, but obviously the political situation makes it very difficult. And on top of that, the cost structure of that oil is higher than in a lot of other regions in the world. I can tell you with certainty that the economics on Venezuela are significantly worse than the Permian Basin.
How, well, in what way?
The cost to lift
The
any
cost to lift,
the
the
cost to
cost to
lift a barrel
extract.
of oil exactly is significantly higher. Yes.
What is the cost here in the United States, say
Mhm.
in Texas? I'm
Mhm.
watching Landman. So, and I see these independent companies that are in West Texas.
Mhm.
What's the break even price? I mean, because
It,
the independents, I mean, they have to have a profit, but the price drops, say, in the low 50s, below that. I mean, they're
mhm.
going bankrupt, right?
Not really. Not really. So there's two ways to look at it. There's a full cycle basis and there's a half cycle basis. So on a variable cost basis, once you build the infrastructure, on a variable cost basis, some areas they're geologically more prolific. You could look at $20 a barrel in terms of lifting cost.
Wow.
Um, in some others, it could be close to 50, but the news that I was telling you yesterday about Bakken shutting down production,
Hmm.
that's more the exception than the rule. But again, on the margin, it matters. But I would say most oil companies operating in the US in unconventional, $50 is, it's not bonanza, but it's okay.
Yeah, it's not bad. It's livable. It's a livable wage at that point.
Yeah,
So
yeah, they can
that
live
makes
to fight
sense.
another day.
Let's turn the page now and pivot to electricity. Now, the last time you were on the show, we touched on it a little bit, but
Mhm.
as you know, AI data centers are booming everywhere. They're actually, the president just today announced that in Pennsylvania, Jersey, and Maryland, he is going to ask those data centers to actually take a big portion of the utility costs as they're building these behemoth places. I know in Texas, Oracle has a huge data center that's being built. I'd imagine it will be running on windmill power, but that's another topic. But with electricity and the boom that's taking place and the expectation of this exponential growth in 2026, how is Ardinall and investors taking advantage of this?
I mean, I think the electricity sector was left for dead for a really long time in terms of investors' interest. And, utility investors were almost like dinosaurs. And now all of a sudden you're seeing this boom after 20 years of frankly nothing really happening in the utility sector. We used to see the EV adoption and the reshoring and the electrification in general of, heating and cooling as a potential step change driver in the power sector. And then when the AI data center uh, segment started coming in, the magnitude of that dwarfed anything else that we'd seen, right? So that's why you're seeing the announcement today. We're talking about loads that are just unimaginable. The amount of power that you're going to need for those is just so significant. It completely derails the way that our power systems are currently set up. So, you're seeing pressures. We it's not that power bills right now are cheap, right? Like they've already suffered from inflation, just general inflation in the last 10 years. There's been a lot of inflation, not from a generation standpoint, because obviously natural gas in this country is very, very cheap. Wind and solar have become very, very competitive, but more from a transmission and distribution standpoint. So the cost to the customer, the cost has gone up because of the network increased cost. And now you're seeing this pressure from the AI data center. So it's completely understandable that you're seeing that from policymakers. You're seeing that from corporates, right? Like when you listen to the various CEOs of power companies, they worry about affordability. That is at the top of their mind. So it's not crazy to see these significant load centers of growth coming from AI data centers having to really pay their fair share in terms of the disruption that they're causing because of the demand pull on the system. How is that all going to play out? It's probably hard to tell, but one thing is clear, we're going to need to harden the grid, right? We're going to need to make more transmission, high voltage transmission investments. We're going to need to make a lot more investments in generation. The generation might be linked to the data centers. They might be connected through, what they ideally want to have is long-term fixed price contracts. But that is really, really good for, frankly, the suppliers to the power sector, right? The picks and shovels, the folks that sell, generators and turbines and high voltage equipment and medium voltage equipment. So a lot of goodness playing the picks and shovels in our opinion. And that's where we've been focused a lot over the last year.
The data centers seem to be located within a 25-mile radius of big cities.
Mhm.
So wouldn't the infrastructure improvements, the as you mentioned, the with the electricity having to come and find more power, doesn't that fall back to the local and state level rather than a federal level?
It depends for training, for AI training. You can have that in more remote locations, but once you're going to shift the load from training to inference, you're going to want that to be as close as possible to the demand. So yes, theoretically, if you put a big data center next to a, metropolitan area, that will impact the wires, right? Like the way
Right.
that electricity gets distributed. And that's what I think the administration is trying to address with this framework, the executive orders that are coming out, the fact that the data centers have to pay their fair share in terms of the burden on the broader grid.
How can
And
investors
and
take
and and
advantage then
and,
of
and
the
frankly,
of
and
this boom?
frankly, the economics of the data centers, the power as a percentage of the total cost is so small that that's not going to derail the ROI that, folks would be getting on their AI investments, right? Like there's a big debate right now in the tech sector. Will these companies be able to get the required ROI to justify all the investments that they're making today? Uh, One thing is clear, power is not going to be the determinant cost, right? Like it's not going to make or break their economics. Power availability will, right? Because they might not be able to execute on their growth plans. But the power cost itself is so small versus the cost of their infrastructure and their servers and everything else that that's not going to massively impact the economics. So I think the thinking is that they can afford to pay a little bit more to be able to keep retail bills fairly fairly flat.
So you're speaking on for the data center then. What
Hmm.
you're saying is that the electricity cost for them really is just it's a small fraction of
Versus the rest of the infrastructure cost. Yes.
right. And I can understand, especially for example, NVIDIA chips, the Blackwell chips go for 14,000 a piece. So I'd imagine you need quite a few of those too in these AI
Yeah.
centers.
Yeah.
So, but then if that's the case, then what is it about electricity? I mean, because there is more of a demand, and then we also have issues from an infrastructure standpoint. Why are these electricity, for example, in the state of Maryland, which is big on renewable energy, but in state of Maryland, they've seen their electricity costs double in only 2 years. I mean,
Hmm.
it's not like there's a flood of people moving into Baltimore. So how did that happen?
Well, the broader DC area was the first one to really see a surge in AI data center build out. So I think that they were the first ones to see the cost of power prices go up. But when you look, for example, in the Northeast, you could you you've seen inflation in their power bills, but it's not coming from AI data center build outs. It's coming from just general inflation, right? Like
Hmm.
the fact that there's a lot of investments that had to be taking place to accommodate for EV chargers and accommodate for heat pumps and all of these other things that we've been investing over the last 5+ years. So the bad news is that if we don't do something about it, power prices for you and I will only go up from here and they will go up a lot more because of AI data centers. I think the DC metro area was kind of like the first one in, so you're seeing
Hmm.
that more so than in other regions. But folks are complaining in the Northeast about power prices. Folks are complaining in other regions, but they haven't even seen the impact of AI data centers. And that's why we have to be so extra careful about how we let all of this play out.
Okay. Here's another question, a follow-up question, I guess. So now with Ardinall, I know that your focus and as well as your firm's focus, there is this concentration on renewables. Let's talk about renewable energy. We were talking about windmills. Is there a renewable energy out there that doesn't seem like a fad, but is actually going to stick and is something that investors could take a look at?
Well, I think utility solar is clearly very competitive, right? Onshore wind is also competitive in different regions. The jury's still out on offshore wind, Todd, and I'm sure you've read the same stories or the same newspapers as I have. But I think
Mhm.
onshore wind and solar are going to be part of the mix. They're very competitive with the current alternatives, natural gas and in some regions, obviously still coal. We still burn coal in this country. There's also nuclear, right? And that's renewable, that's green. And the whole promise of magnetic fusion, right? And other disruptive geothermal. I think that we're going to see big breakthroughs in geothermal over the next 5, 10 years.
Wow.
I can't give you a big time. We're kind of just on that, hockey stick like inflection point in geothermal. But I think that what I'm seeing from the early stage venture community and some of the newcomers or some of the technology solutions provided into the geothermal space, I think that there's a lot of promise to be able to drop the cost down and make that super competitive. And I mean, that would be incredible, right? Think about the fact that you can drill and have permanent
Oh yeah.
electricity. So that is very promising. Onshore wind and solar are already established. I would watch geothermal very closely, and then any other, you know, disruptive technologies further out, like magnetic fusion, super exciting. The timeline of those are very, very hard to pinpoint.
Is Ardinall going for the rest of this century with that concentration, thinking that that is where the majority of energy is going to be created in these renewables, like a geothermal, or do you think we'll be touching on this oil topic for the next, dozens of years?
The demand for energy broadly is going up so much that we will be using more natural gas. We will be
Hmm.
using a lot more solar. So solar as a percentage of the pie will grow significantly. And because the technology is mature, you can underwrite that with a lot more certainty. In the case of geothermal, you do need to see those cost downs
Hmm.
to be able to comfortably say that, yes, that's going to scale up. So that's still not ready for prime time, but natural gas, solar, wind absolutely are.
I've heard that before about AI. It's not ready for prime time, so
Well,
it's going to be an exciting
you
century.
can't bet against human innovation, right? Like that's ultimately what it is. Can we put our heads together and find ways to make the same thing cheaper? And, AI told us, yes, we can. And a lot of these hard science problems can be solved with human ingenuity.
Yes, I do agree with that. Maria, I always love having you on the show. You have just an amazing way of explaining all this for our audience, and so everyone can understand it. And I can't wait to have you back later on this spring.
Todd, always so much fun. So happy to be back. Great to see you, and good luck with the markets. In the meantime, enjoy the long weekend.
You too, Maria. Thank you so much. So, on behalf of Maria Jelescu Dreyfus, I am Todd Schoenberger. Thank you once again for joining us on the Money Path. We'll catch you next time. Take care.
Access real-time data and intelligent analytics exactly when you need them. Get the right data at the right time. Learn more at quotemedia.com.